Dollar cost averaging. What is it? Investing can be difficult. Even seasoned investors who attempt to timing the market to buy at the most advantageous times may not succeed. By automating purchases, the dollar cost averaging method can make it simpler to manage with volatile markets. Additionally, it encourages regular investing on the part of investors. Regardless of price, dollar cost averaging is investing the same sum of money in a target security at regular intervals over a predetermined length of time. Investors can lower their average cost per share and lessen the effect of volatility on their portfolios by employing dollar cost averaging. This tactic effectively does away with the need to try to time the market to buy at the best pricing. Dollar cost averaging is also known as the constant dollar plan. How to use dollar cost averaging? An investor can employ the straightforward strategy of dollar cost averaging to accumulate savings and wealth over time. Additionally, it gives investors a means to disregard recent market volatility. The application of long-term dollar cost averaging in 401k plans, where employees make regular investments regardless of the cost of the investment, is a prime example. Employees who participate in 401k plans can pick the investments they want to make and the amount they want to contribute. After then, investments are made on autopilot each pay period. Employees may notice a greater or lesser amount of securities added to their accounts depending on the markets. Using dollar cost averaging is not restricted to 401k plans. Investors can use it, for example, to regularly acquire mutual or index funds, whether in a taxable brokerage account or another tax-advantaged account like a conventional IRA. One of the finest trading methods for new investors wanting to trade ETFs is dollar cost averaging. A lot of dividend reinvestment plans also permit investors to dollar cost average their investments by making consistent purchases. Dollar cost averaging's advantages: the average amount you spend on investments can be reduced through dollar cost averaging. It supports the routine of consistently investing in order to accumulate money over time. Because it operates automatically, you won't have to worry about timing your investments. It eliminates market timings problems, such as buying only when prices have risen. It can make sure that you are prepared to buy when prices rise and that you are already in the market. It eliminates emotion from your investing and keeps you from perhaps lowering the rewards on your portfolio. To whom should dollar cost averaging be used? Any investor who wants to benefit from the advantages of the dollar cost averaging investment strategy, including a potential lower average cost, automatic investing over time, and a strategy that relieves them of the stress of having to make purchase decisions quickly when the market is volatile, is welcome to use it. Beginning investors who lack the knowledge or experience to determine the best times to buy may find dollar cost averaging to be extremely helpful. For long-term investors who are committed to making regular investments but lack the time or desire to follow the market and time their orders, it can also be a solid strategy. However, not everyone should use dollar cost averaging. It may not be suitable for investors at times when prices are steadily moving in one direction or the other. When deciding whether to employ dollar cost averaging, be sure to take into account both the broader market and your expectations for the investment. Is dollar cost averaging a good idea? It is possible. By investing the same sum on a monthly basis, dollar cost averaging aims to reduce your average purchase price. When prices decrease or increase, you will already be in the market. For instance, you won't need to try to time dips because you'll be exposed to them as they occur. You will end up purchasing more shares when the price is lower by consistently investing a certain amount than when the price is higher.